The financial challenges of small businesses. Running a small business comes with many financial hurdles, cash flow gaps, unpredictable revenue, and limited planning resources. Many entrepreneurs find themselves reacting to problems instead of strategically planning for growth. These issues often trace back to one root cause: the absence of financial leadership. Hiring a full-time CFO may be out of reach for most small businesses. However, outsourcing this role can be a game changer. An outsourced CFO provides high-level financial strategy and oversight without the overhead costs of a full-time executive, making it one of the smartest moves a business can make. What is an outsourced chief financial officer? In times of high growth, sales, or liquidation, an accurate and well-structured capital account system can be the difference between smooth distribution and litigation. Let's demystify this with a vivid example, a Bitcoin investment that skyrockets in value, and see how different allocation strategies affect member outcomes. What are capital accounts? A capital account is a personalized ledger for each LLC member. It answers one simple question: what is my economic interest in this business? This includes contributions, initial and subsequent contributions of cash, property, or services, allocated profits or losses, based on the LLC's operating agreement, distributions, withdrawals made by members over time. Capital accounts are updated annually and reported via IRS Schedule K1, which breaks down each member's share of income, deductions, credits, and other items. Schedule K1 is essential for preparing personal tax returns, but more importantly, it reflects the heartbeat of each member's capital activity. When an LLC liquidates, these capital accounts determine how remaining assets are distributed after paying off liabilities. Case study: the Bitcoin Bonanza. Let's consider a Florida-based LLC formed by three partners. Each contributes $35,000 in year zero to buy one Bitcoin for $105,000. The LLC holds the Bitcoin for 5 years. Meanwhile, partner 3 contributes another $25,000 in year 1 and year 2 to cover operating costs, totaling $50,000. In year 5, the Bitcoin sells for $10 million, generating a capital gain of $9,895,000. Now comes the big question: how should the LLC allocate this windfall? Scenario 1: equal profit and loss allocation. This is the default for many LLCs. Profits and losses are split equally unless stated otherwise in the operating agreement. Initial capital, $35,000 each. Partner 3 adds $50,000. Losses, $50K, split equally, 60 cents per member. Gain, 9.95 minutes, split equally, 3,298 minutes per member. Final balances: partner 1, $3.316 million. Partner 2, $3.316 million. Partner 3, $3.366 million. Insight: clean and easy, but partner 3's larger investment isn't reflected in the distribution, possibly leading to resentment. Scenario 2: profit by contribution, losses equal. This approach splits profits based on total capital contributed, $35,000 plus $35,000 plus $85,000, but divides losses equally. Partner contribution ratios: P1, 22.58%, P2, 22.58%, P3, 54.83%, losses, $16,666.67 each, profits, allocated per contribution ratio, final balances: partner 1 and 2, $2.25 million, partner 3, $5.49 million. Insight: balances simplicity and fairness. Partner 3 receives more of the upside, but all share the operational burden. Scenario 3: profit and loss by contribution. Here, both losses and profits are allocated according to each partner's percentage of total contributions. Losses: P1 and P2 lose $11,290.30 each. P3 loses $27,419.35. Gains: same split as scenario 2, Final balances. Partner 1 and 2, $2.26 million. Partner 3, $5.48 million. Insight: this method closely reflects actual financial participation. Partner 3 takes on more risk and is appropriately rewarded. Practical tips for LLC members and managers. Define profit and loss. Allocation in writing. Your operating agreement is the law of the land. Clarify how profits and losses are split to avoid misunderstandings. Track contributions accurately. Every dollar or Bitcoin matters. Record who contributes what and when. Understand your K1. It's more than a tax form. It mirrors your economic stake and should align with the operating agreement. Monitor capital accounts. Quarterly. Don't wait for year-end. Regular checks help prevent surprises during distributions or exits. Conclusion: the Bitcoin takeaway. Whether your LLC invests in crypto, real estate, or tech, the mechanics behind capital accounts are universal. Equal splits may be convenient, but fairness often demands deeper analysis. Choose the method that reflects your business goals and partner expectations. And always, document, track, and review. Behind every K1 is a capital account telling the real story of your partnership.